Hey guys, welcome to CAD Planning. Now we are going to see Consolidation chapter AS 21, practical question number 10. Okay, let's do together. Okay, first point we need to take date of acquisition 31st March 2020, date of consolidation 31st March 2021. Okay, after this we read the question. The following information is also provided to you. H Limited purchased 180 lakh shares in S Limited on 31st March 2020 when the balance of general reserve and P&L account of S Limited stood at 3 lakh and 1 lakh 20,000 respectively. When H Limited purchased S Limited, the balance of general reserve and P&L is 3,000 lakh and 1,200 lakh. Okay. But on the date of consolidation, the reserves and surplus, general reserve has reduced and P&L also reduced. P&L is increased. Okay. Let's read the B point. On 1st April 2020, S Limited declared a dividend at 20% for the year ended 31st March 2020, which means pre-acquisition dividend. They have declared dividend in pre-reserves. So this is pre-acquisition dividend. H Limited credited the dividend received by it to the P&L account. Again, rectification entry. H Limited wrongly credited to P&L account, but it should be credited to cost of investment account. Because pre-acquisition dividend will always come, we always deduct from cost of investment. So cost of investment account will be credited, not P&L account. C point, on 1st January, S Limited issued 3 fully paid up bonus shares for every 5 shares held out of balances of its general reserve as on 31st March 2020. On 1st January, bonus issue has happened. Okay. Out of general reserve. Bonus issue happened out of general reserve. Okay. And D point, on 31st March 2021, all the bills payable in S Limited balance sheet were acceptance in favor of H Limited, but on the date H Limited held only 45 lakhs of these acceptance in hand. The rest have been endorsed in favor of trade payable. So D point is intercompany transaction. 45 lakhs bills payable for S Limited and receivable for H Limited. Next, on 31st March 2021, S Limited inventory included goods which it had purchased for 100 lakh from H Limited, which made a profit at 25% on cost. This is downstream transaction. Downstream transaction is holding to subsidiary sold goods. Upstream transaction is subsidiary sold goods to holding. So this is a downstream transaction. Let's see in answer. So first point is over, date of acquisition, date of consolidation. Second point, we need to compute holding percentage of holding and minority interest percentage. Okay. Before that, see the A point. H Limited purchased 180 lakh shares on 31st March 2020 when the balance of general is okay. On acquisition date, he purchased 180 lakh shares, but here the share capital is on consolidation date. This is not acquisition date. So we need to add 180 plus bonus issue. Bonus issue is there in C point. We need to add bonus issue so we can find the percentage of holding and percentage of subsidiary. Let's see. Before bonus, 180 lakh value of shares. Sorry, not value, 180 lakh shares. After bonus, same 180 lakh shares plus for every share S Limited issued 3 fully paid up shares for every 5 shares held in subsidiary company. So for every 5 shares 3 shares issued. So 180 lakh into for every 5 shares 3 shares issued. So 180 into 3 by 5. If we do that, 180 lakh plus 180 into 3 divided by 5, 108 lakh. 108 lakh. So we will get 288 lakh after bonus. So in question, equity share capital 4800 S limited, value of shares divided by 10 rupees, 480 shares, 480 lakh shares. So holding percentage equal to 288 lakh out of 400 lakh, 480 lakh, 480 lakh, 60 percentage, minority interest 40 percentage. Okay. Third point, we need to analyze reserves and surplus into pre-acquisition and post-acquisition. Okay. First, we need to find how much bonus issued from general reserves, because they told that bonus issued from general reserve. So we need to find how much value of shares issued from general reserves. In previous step, we found that 288 lakh out of 480 is 60 percentage. After bonus issue, 288 lakh is 60 percentage. So before bonus issue, 180 lakh will be 60 percentage, because before or after bonus, same percentage will be there. There will be no difference in percentage, because capital will be same. Bonus, if bonus issued, resource will reduce and capital will be increased. So percentage will not be differed. So before bonus issue, capital shall be 180 lakh. 180 lakh is 60 percentage. So 100 percentage is 300 lakh. 300 lakh shares into value 10 rupees. So 3000 lakh shares. These 3000 lakh shares is capital, share capital before bonus, right? Share capital after bonus equal to how much? 4800 lakh. So difference 1800 lakh is bonus. Bonus issued on general reserve. So in general reserve, 1800 will be reduced. Okay. Let's first analyze general reserve. General reserve amount before bonus issue is 3 lakh. So 3000 lakh, sorry, 3000 lakh. These 3000 lakh, is pre-acquisition reserve. Okay. And we issued bonus. So minus bonus 1800, 1200 lakh is balance. This is pre-acquisition. Okay. But in question, balance sheet, they have provided general reserve 1380. So 1200 pre, balance in balance sheet they have told 1380. So difference is 180. This is post. Okay. This is transferred from P&L account, I think so. So this is post. So pre-general reserve is, pre-acquisition general reserve is 1200, post-acquisition general reserve is 180 lakh. Okay. Now go to P&L account. P&L account. What is the opening balance? 1200. So P&L 1200 opening balance. And on 1st April, S Limited declared dividend 20% for the year ended 31st March 2020. S Limited credited the dividend received by its to the P&L account. Okay, first of all, this P&L 1200 opening balance is pre-resource, pre-acquisition resource. So in this reserve, dividend is paid. So minus dividend. How much? 20%. Share capital 4,800. 4,800 into 20 percentage. Sorry, we cannot do that because this is on the date of consolidation and dividend is issued on the date of acquisition. So these 4,800 will not be taken. These 3,000 lakh will be taken. Where this 3,000 lakh will be taken for bonus issue. So 20% will be 600 lakh. 600 lakh. Already 1,200 there. It's not bracket. 1,200 there. 600 lakh we need to minus. So remaining 600 lakh is there. So this is pre-acquisition reserve. Pre-acquisition reserve. In balance sheet, P&L is 1,620 is there. So on the date of consolidation, on consolidation date 1,620 is there. So we need to minus the pre-reserves. If we do 1,620 minus 600, you will get 1,020. This is post. Out of 1,620, 600 is pre and remaining is post acquisition reserves. And it is assumed that this 1,020 post acquisition reserve is after transfer general reserve. General reserve we transfer 180 lakh, and this is after transfer general reserve. Okay, it is assumed. So we add total pre reserves, total post reserves, post acquisition, pre acquisition equal to general reserve pre-acquisition 1,200, in P&L pre-acquisition 600. So pre-acquisition 1,800 lakh. In P&L post-acquisition 1,020, general reserve post-acquisition 180. So 1,200 lakh post. Okay. Next point. Next fourth point, apportionment. We need to segregate pre-reserves, post-reserves for holding and minority interest. Okay. Particulars, total holding, minority interest. Holding how much percentage? 60%. Minority interest 40%. Okay. Point 4, follow my step. In ICA module, it is so confused. So in all sum, follow my step, like apportionment. First we need to put share capital apportionment. Second, pre-acquisition resource. Third, post-acquisition resource. Share capital on the date of consolidation, how much? 4,800. Pre-resource above amount 1,800, and post is also we wrote in above 1,200. So we need to apportion this 4,800 into 60%, 2,880, 1,920. Okay, 1,080, 720, 720, 480. If we add minority interest, we will get minority interest amount. 3,120 is minority interest amount, and this is magic. And this step, and after this, we need to compute cost of control, right? For cost of control, net asset is what? Share capital plus pre-acquisition resource. Why pre-acquisition resource? Because for cost of capital, net asset on the date of acquisition. On the date of acquisition, there will not be post-acquisition resource. So pre-acquisition resource will be taken. So for net asset calculation, for cost of control calculation, net asset will be calculated. How? Share capital plus pre-acquisition resource holding into, sorry, we should be added both for net asset. And we need to reduce cost of investment. Okay, and these 720 alone will go to resource and surplus of consolidation resource and surplus for balance sheet. Okay, so next we will be doing cost of control. Net asset on the date of acquisition. How much? 2,880 plus 1,080. 3,960 minus cost of investment. How much cost of investment? In question they have given shares in S Limited 3,000. So cost of investment will be 3,000. And there is pre-acquisition dividend. Dividend is there. How much? We already calculated dividend is 600 lakh. Out of 600 lakh, only 60% pertain to holding company. So 360. Sorry, we need to minus from cost of investment. So 2,640. So cost of investment is lower, net asset is higher. So capital reserve. How much? 3,960 minus 2,640. 1,320 capital reserve. Okay. Now consolidated reserves and surplus. Okay. First we need to add holding company resource. So resource of holding company. General reserve, how much? 2,784. P&L of holding, how much? 1,620. Here we need to reduce in P&L. We need to reduce the wrong entry for dividend received. The dividend actually received is pre-acquisition dividend, but here you see the adjustment. H Limited credited dividend received by it to its P&L account. So this dividend is pre-acquisition dividend. So he wrongly credited P&L account, but he should have credited cost of investment account. So he already added P&L and dividend. So we need to reduce the dividend. He already added the dividend, so we need to reduce the dividend. How much? Rectification. Dividend is 600 lakhs into holding percentage 60%. So 360 to reduce 360. Okay, and there is downstream transaction. On 31st March, inventory included goods which it had purchased for 100 lakhs from H Limited, which made a profit of 25% on cost. S Limited purchased from H Limited. Subsidiary company purchased from holding company. So it is downstream transaction. H Limited sold to S Limited. So downstream transaction. Okay. For downstream transaction, there would have been unrealized profit. Okay. Before consolidation, there is intercompany transaction. So after consolidation, it is H asset. S Limited subsidiary company is holding company. Both one balance sheet. So the assets of S Limited is H Limited asset. So we don't need to put unrealized profit. So reduce from H Limited resource and surplus, because H Limited sold S Limited. So reduce from H Limited P&L. How much? On profit of 25% on cost. Only profit reduce. So here I would have explained easily. Downstream transaction. If holding company sold to subsidiary, unrealized profit reduced from resource and surplus of holding plus stock of subsidiary. Okay, both area. Resource and surplus of holding we need to reduce plus stock of subsidiary. Stock of subsidiary means in balance sheet we need to put stock. So reduced in balance sheet. Okay. Upstream transaction. Subsidiary sold to holding. So what to do? Unrealized profit if any on closing stock reduce from resource and surplus of holding. You need to reduce resource and surplus of holding and resource and surplus of minority interest, which is very important. We put minority interest calculation, right? There we need to reduce the unrealized profit. Okay, because subsidiary sold to holding. Okay, so holding percentage differs. So minority interest percentage differs. So reduce that from minority interest also. Okay, and stock on holding, because holding is holding company is a purchaser and holding company has a closing stock. So reduce from stock on holding. Okay. Here there is a downstream transaction under lakh, profit 25% on cost. Okay. Under lakh is 1 minute. Downstream 100 lakh is selling price. So 25% on cost means this 100 lakh is 125. So 25 is profit. 100 rupees cost plus 25 is profit. So 125. This 100 lakh. So into 25 is what amount? 100 divided by 125 into 25. 20 lakhs. So 20 lakhs we need to reduce. Here dividend 360. So what is the amount? 1240. Sorry, I forgot that I taken subsidiary P&L. Holding P&L is 2715. So 2335. Okay, 2335. And subsidiary resource and surplus and holding percentage. How much? Here you can see post acquisition resource holding company 720. So post acquisition resource of subsidiary company on holding percentage. How much? 720. So 720. And we found that in cost of control capital reserve is there 1320. So capital reserve is a resource surplus. So add back capital reserve also. Capital reserve. So how much? 1320. Capital reserve 1320. So if we add this, we will get 7,159. And the sum is over. The sum adjustment are over. Now we will do balance sheet. I think balance sheet is easy. I will say what are the adjustment will change. Here you can see in consolidated balance sheet, note 1, bills receivable and bills payable will be adjusted to the extent of 45 because intercompany transaction is there. So trade payable, holding company trade payable plus subsidiary company trade payable minus 45. In trade receivable also minus 45. In inventory there is downstream transaction. So we need to reduce subsidiary inventory by 20 rupees because 20 rupees is stock reserve. So add holding plus subsidiary and minus stock reserve 20 rupees, and that's it. These adjustments are in balance sheet. So rest of the balance sheet is easy. You can do it by yourself. Thank you guys.